elevation. Big blunts, dope boys wanna smoke with me. Now we ride double M's through the whole city. Niggas talking down, but they always feel me. A 9-figure nigga, all I wanna talk is business. I seen a big mouth get a closed casket. Self-made, took over the whole racket. A kilo after kilo, see who moved the most. 200-foot yacht, she wanna see the coast.
What's going on, guys? Welcome back, all right, to a Patreon promotional, all right, meaning that this will go on the Patreon first and then make its way onto YouTube later, all right. Request on this ticker, interesting proposition on this play, all right. Ticker is FUN, fun, Six Flags Entertainment Corporation, all right. Most people in America probably know what this is, all right. This is an amusement park company. They own several properties across the United States and actually in Mexico, but we'll get to that. Trades on the New York Stock Exchange, $15.64. Market cap is $1.59 billion. All right. Price action on the chart almost looks like a roller coaster. Long term, no pun intended. All right. But on a serious note, it sounds like it hasn't been fun for shareholders. Management doesn't seem like it's been fun for them. I mean, this is a heck of a company, all right? We're going to get more into it. We'll talk about it operationally speaking and so forth. So, this company is headquartered in Charlotte, North Carolina. They own properties in the United States, Mexico, and Canada, all right? The company was formerly known as Cedar Fair LP and changed its name to Six Flags in 2024. Company was founded in 1983, and it's always been headquartered in Charlotte, North Carolina. Now they got 5,000 employees. That's a lot, but a lot of these are probably your part-time seasonal workers, kids that are in school, high school, that are off for summer vacation, trying to just get a seasonal job, that type of idea. Some states, I think the age limits vary. I think in Texas, maybe a 15, 14-year-old or something can take up a little part-time gig at one of these, seasonal jobs selling, I don't know, selling turkey legs or hot dogs or whatever on a stand within the park. All right. So let's talk about some stuff with this equity. All right. I've digested their earnings, their whole situation, why the stock is down, what's going on, and just all different angles. Let's do a sniff check first. All right. Valuation. They got $70.93 million in cash, $5.24 billion in debt. Market cap once again is $1.59 billion. Enterprise value $7 billion. All right. This is a heavy property, plant, and equipment equity, meaning that the infrastructure of all their parks, they own roller coasters, land, big land masses, and high location, high populated locations and so forth. So let's do a little sniff check on their balance sheet. All right. So 10 years, they had 119.6 mil in cash. Now they got 70.9 mil in cash. We'll go to their total debt. All right. 10 years ago, we had 1.5 billion on a rounding error. Now they got 5.2 billion on a rounding error. So cash is going down, debt is going up. Not what I like to see. Property, plant, and equipment, though. Gross property, plant, and equipment. Let's look at that. So on the long-term assets of the balance sheet, 10 years ago, they had 2.9 billion. Now it's worth 7.5 billion. All right. So offset, all right, on cash and cash equivalents going down, debt going up, gross property, plant, and equipment, and total assets, this offsets. Okay. All right. So I like to see that. But closely following the debt is trailing on the long-term liabilities. All right. but for all extensive purposes, total assets still outweigh total liabilities. Arguably, someone can argue against it because there's 2 billion in goodwill right here, against the actual liabilities column of the long-term debt and so forth. So, I mean, it just depends how you look at it. All right. They can, goodwill depreciation can be a negative drag, but at these valuations at this point, I mean, it doesn't really matter because the equity is trading so cheap. All right. So let's look at actual margins. Gross margin is 36.34%. Positive EBIT and EBITDA. EBITDA has been the main metric that the management has been going off of. Net income is negative 56.44%. Leverage free cash flow is down slightly in a negative 4.85. All right. So for all extensive purposes, they're negative. They're losing money. All right. Stock-based comp looks like it's going up. Let's go down to their cash flow statement on an annualized basis for 10 years. Looks like they had 132.5. Now they're at 152.3 negative. So not good. All right. Moving on to their income statement. All right. This is really what we need to be looking at as far as performance wise of CEO and so forth. All right. 1.2 billion in revenues 10 years ago to trailing current 3.1 billion. So revenues tripled, sales tripled in a decade. That's good. Your cost of revenue, however, has been increasing, kind of outpacing the actual sales growth, if you will. So, nevertheless, gross profit is producing and bearing fruit. All the line items going down, expenses are going up. All right, and it's outpacing revenue, and it's not accretive to value. Really, let's look at the share count. Share count on a rounding era, 56.4. Current 100.4. So a rounding error, they doubled their shares. All right. So where everything is up and down, the balance sheet, cash flow statement, it's a roller coaster all over the place. No pun intended again. All right. How, whenever I do a stock analysis and I look into under the hood of a business, I try to see where the value creation is to the shareholder. What is going to make the stock go up? And with this type of business model being a seasonality and high opex, so forth, what is it? All right, dividends, guys. When you have a business model like that, cash flow is really where cash flow is going to be king to what this business model is going to provide and what this business is here for. We'll look at the dividends column here. They're not currently paying a dividend, but we look at their history. Look at the history of the dividends. All right. In 1989, they started with 14 cents a share. And all the way up to 2020, before the pandemic, they were doing 94 cents a share. So pretty much shy of $1. And then COVID hit, shut down, and then dividends were cut. They tried to reinstate a dividend to stop the bleeding in 2022 with a flat 30-cent dividend. We'll see what that did to the stock. All right. So 2022, they started one. So stock, it's stable and it did its part. So the dividend stabilized the equity. All right. As you can see here. So the equity just traded flat, as they grew earnings throughout. And then when they cut the dividend, we'll look at the history again. Cut the dividend in June of 2024. All right. You go back. We'll go to June of 2024, which is the last time they paid the dividend, and they cut it. All right. And ever since then, equity's been going down. All right. Once again, the proposition of this business model is cash flow. All right. and paying out dividends to shareholders. Nothing wrong with that. Every company has its purpose. Some is some in different stages provide dramatic capital appreciation growth. If you're new here, or if you're not new here, that's I do a lot of that on my channel. I invest in a lot of mid and small high growth stocks, and for all extensive purposes, it's treated me well. Disclosure will go to my portfolio. I do not own Six Flags, so you're getting a non-biased opinion here. All right. I assure you, this position right here, all right, this blanked out one is not Six Flags, as you can see. That's my current play. All right. Quick little plug. If you want to know what the current play is, if you want to benefit off a community of like-minded investors, if you want to grow your mind and understand how this all works, and put more tools in your toolkit as an investor with a hardcore community of growth investors and more direct access to me, check out the Patreon. $10 a month. I think you really can't beat it for the value you get. You're going to get instructional content, different products that are included in the membership, everything you need to be a growth investor and know how to actually get results that outperform dramatically. It's on there, guys. All right. So check that out. All right. And don't forget to thumbs up and like and subscribe to the video if you're getting how do you say, value. All right. So going back to it, earnings call. All right. What's going on with the management? How is the business running? All right. So metrics are down across the board, guys. Everything is going wrong, bad weather, slow macro. The business is just not, the margins are kind of falling apart. EBITDA is down, operating costs and expenses, I mean, that's down, but still, net revenue down. In park per spend per capita is down 4%. People are not spending as much money at these parks. All right. They're being more frugal. The only, marginal 1% increase in guests, big, in guests that come to the park, big whoop. All right. Challenges, they've had it. Even on the executive side, all right, the CEO is stepping down. I've checked the 10K. They got employees getting fired. Just CEO said, I did this for 40 years. I can hear the tiredness in his voice. He's going to retire. It's all coming to a halt, but that doesn't necessarily mean there's not opportunity. All right. And what do I mean by that? I'm talking about the investment opportunity and timing and valuation and value creation. All right. We'll look at the valuation metrics. They're trading at half of one time sales. Okay. Average median in this sector is trading at 0.94% of sales. So there's reversion to the mean potential. How do I view this equity? All right. And what do I think is going to happen and what needs to happen? Okay. So, new CEO, new strategy. Let's say that I'm the new CEO of Six Flags. What am I going to do? All right. Because I'm looking at all of the financials. It's pretty simple. I think that they got tailwinds coming. All right. Because there's seasonality aspects of macro and a lot of stuff involved. So interest rate cuts are coming, probable stimulus, amusement park sales have been down. People are not going out as much. I think that will change. All right. I think the economy will speed up. I think that people are going to get a little tired of being at the house, and they're going to have a little more capital, and they're going to want to take their families out on vacations. And I think that what's happened is a lot of these amusement parks, if you've been, the prices have been raised, astronomically. I mean, you can't get a hot dog or a hamburger in one of these parks without losing an arm or a leg, okay? So what operationally needs to happen is they need to stop raising the actual costs. They need to freeze the cost of a drink, freeze the cost of everything. I'm not saying, cut, I'm not saying cut the cost of how much the consumer pays at the park. All I'm saying is just cap it out. That's it. It's no more raising the price of a soda, no more raising the price of, tickets or whatever. All right. Everything, all the prices are frozen. You need to let the consumer and GDP and wages catch up. All right. Because we're way ahead. All right. And that's why marketing, that's probably why their marketing spend is not coming through and bearing fruit. They're marketing to a consumer that's weak. Why, so if I'm trying to sell something to someone that doesn't have any money, what's the point? You're wasting your time and money on the marketing. All right. So they need to cut marketing spend. Everybody knows of the parks. The parks are right there. They're huge. They drive by them. All right. So cut the ad spend, cut the marketing, freeze the amount of pricing at the parks, let the macro catch up. All right. That's what I would do. Meanwhile, I'd start focusing on margins, cutting here or there, maybe not downsizing the parks because the underperforming parks will eventually bear fruit later. All right. On a tailwind. That's what I would do. So, I mean, that's my idea of this. What is the investment proposition? How do I look at this? Well, I think that if they get this cash flowing again, I see this as 5 years projection. New CEO comes in, everything's going the right direction. They get tailwinds. Stock's going to go to $30, $35 in 5 years. Maybe in 3 years. I think within 2 to 3 years, they reinstate and grow the dividend. Maybe it takes 5 years for them to speed that dividend up real fast to get it back up to, oh, say a dollar a quarter. All right, so $4 a year. Meanwhile, 5 years before then, you're paying $15. So, you know, I see this as an opportunity for maybe a more mature growth investor that's trying to rebalance into dividends, but has still some time to let that transition play out. And they want to put a lot of capital in on a rebound play. And once you put the capital in, it just stays there for life, and you just get fat dividends, until you go. All right. I see that as the play here for Six Flags. Not financial advice, but me personally, if I have $1 million, 2 million, and I'm trying to rebalance to dividends, Six Flags may be the play, and I may just own it, and it'll just be in the portfolio. um 10 years out, okay, I think 10 years out, stock will go, it's possible that 10, 15 years out, the stock can go back up to $70, guys. All right. That's the actual stock analysis that I got for Six Flags. I hope you got value. I appreciate everybody's support. Comment down below. Say I'm subscribed. I will respond back to you. Okay. Like and subscribe. I got more content coming. I appreciate everybody's support. I love y'all, and until the next time, take it easy.